Welcome to the Lend Academy podcast, episode number 125. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It. Today's episode is sponsored by Lend It USA 2018, the world's leading event in financial services innovation. It's going to be happening April 9th through 11th, 2018 at Moscone West in San Francisco. We're going to be covering blockchain, digital banking, and of course, online lending and other areas of fintech. There'll be over 5,000 attendees, over 250 sponsors, and registration is now open. Just go to lendit.com/USA to register. Okay, I'm here in London today at the offices of Pollen Street Capital with Simon Champ. Simon is a pioneer and something of a legend in the online lending space, and he launched the first publicly traded investment vehicle in the P2P lending space back in 2014. We're going to talk a lot about that and many other things today. So let's get going. Welcome to the podcast, Simon.
Thank you very much, Peter. That's a tremendous introduction. I'm not sure if it's fully deserved.
Oh, come on. Anyway, so why don't we start with a bit of background about yourself and what you did sort of before you started this fund?
Sure. Yeah. I think like lots of people in alternative lending, we didn't necessarily spend all of our career in alternative lending.
Right.
I'd actually spent 20 years in equity broking, so raising capital for small businesses at three banks, a German bank called Dresdner, a very English bank called Cazenove, which was later acquired by JP Morgan, and then a bank I helped set up called Liberum Capital, which not coincidentally had quite a big role in raising capital for some of these permanent capital funds in our space. And it was whilst at Liberum that, along with a couple of colleagues, that we saw an opportunity to create a different type of funding maybe for some of the early platforms, which was the birth of that listed vehicle, P2PGI.
Right. So were you looking at Zopa and Funding Circle? What sort of first got on your radar?
I'd actually been privately interested and a very modest investor in a number of other disintermediating peer-to-peer businesses, not to do with finance. So in music, in gambling, in art. So I'd had an interest in the concept of using the internet and technology to disintermediate high-cost businesses. So coincidentally, when I met Zopa, RateSetter, Funding Circle and Lending Club in early 2013, late 2012, there was some sort of resonance maybe with some of those earlier business models I'd seen. And really that's where the concept came from, really, a learning maybe from other industries that had been down the same path.
Right. And so we first met, it was the very first Lend It, actually. We met for breakfast there, if you remember.
I do remember.
And you've come a long way since then. So, and you talked about launching this fund back then. So what was the original intent? What was the original focus of the fund? You called it P2PGI, so I imagine it was a P2P focused fund. But tell us a little bit about those early days.
Yeah, I think in those days, having met 3 or 4 of those early platforms and been really excited by what they were trying to do, but also recognizing, as they spoke to us back then about their challenges of matching. Back then, they were all matching fragmented loans between consumer buyers and consumer sellers. All of those platforms were doing that at the time. Not whole loans, but loans they were fractionalizing to create liquidity.
Right.
And it became probably apparent that, as it would to anyone, that they were doing that because they needed to create liquidity, because most of their investors were relatively small ticket investors and wanted diversification.
Right.
So if an investor wanted to put £1,000 down, he didn't necessarily want to expose his entire £1,000 to one borrower.
No.
So the platforms were doing a great thing. They were fractionalizing the loans. We could also see, though, that fractionalization created challenges in itself about the provenance of the loan, what happens to the loan if it needs to go into recovery. So we started to talk to the platforms about the concept of whole loans being passed to a single buyer or a number of buyers. So I think the early thought was to create liquidity, a pool of liquidity to allow the platforms to work with, in addition alongside their retail customers. It was never designed to somehow replace retail,
right,
or be any better, frankly, in some ways than retail. It was meant to give institutions an access point to an asset class, and bring in some fiduciary skills that maybe aren't always present in retail. So maybe multiple platform access, different grades, some form of loan selection, possibly geographic diversification, potentially the use of leverage, which would only really become available if you owned a whole loan.
Right.
So we set about creating a whole loan vehicle that gave institutional fiduciary confidence to investors. Because on the other hand, having raised money for lots of companies for 20 years, it had become apparent by 2012-13 that there was a real appetite for income that you were not necessarily getting through other financial exposures like
right,
traditional banks, who had a tough time by 2012.
Okay. So then, what was it like? You raised, I think it was £200 million, wasn't it, for that first fund? What was it like actually going out there and raising money? Was there a lot of resistance? Was it a hard selling point?
Do you know, I think everybody likes to think they're good at raising money. But the reality is that you're only as good as the product. I mean, no one's going to invest in your product unless... and I think it had a resonance at the time that many of the investors we went to see... Remember, we didn't go and see retail investors. We
right,
went strictly to professional investors and equity investors. That's a key. This is an asset class of debt, but P2PGI is an equity. Mm-hmm. So you're wrapping debt in an equity wrapper and delivering something that maybe those equity managers hadn't seen before or hadn't had the opportunity to be exposed to. And I found back then the immediate comparison in most of the meetings was with banks. It was the investor who liked the vehicle saw that you were accessing lending just like a bank does. You were delivering a good chunk of that coupon back to the shareholder just like a bank tries to, but because of the more direct relationship and the lack of infrastructure of a bank in the P2P model, then you were effectively trying to deliver that return without the leverage, without the many layers of leverage that banks require to return an ROE. And it was that resonance, the lower leverage and therefore lower risk, we believed lower risk, that was certainly, I think, drove a lot of interest at the time. It was, I think, for many investors, it was seen as a partial bank replacement, but they were still funding the growth of the UK or the US consumer through their capital commitments.
So then, when you launched, how many platforms did you launch with? Do you remember?
We launched with 4 actually. We launched with Zopa, RateSetter, Funding Circle, and a relationship with Lending Club. And that was around the same time. You might recall that we acquired a business called Eaglewood in the US.
Yes.
It was set up in the US by John Barlow, Steve Lee. They had, almost in a mirror world, done a very similar thing in the US. I just hadn't been aware of them. And they'd done a great thing and gone out and created a relationship with Lending Club that we saw an opportunity to maybe bring that into the whole building or bring it into that in-house and create a truly global product for UK listed investors. Otherwise, I don't think there was anything wrong with Zopa, RateSetter, Funding Circle at the time, but it definitely gave it an international feel, a breadth, a diversification. And we also became aware that leverage and the possibility for leverage was more mature in the US at that time. It was more mostly because of the work the Eaglewood guys had done with Lending Club to create that path. Right. So 4 platforms on day one, which quickly evolved to circa I think we've worked with close to 20 over the last 4 years.
Mm-hmm. Okay, and so geographically, where are you now?
I think geographically, there are, whilst it says P2PGI, I think a couple of things have evolved. In fact, many things have evolved over the last 4 years, and it's changed immeasurably. And we can probably touch on the concept of P2P, the very name of the platform, because that's evolved immensely. But we've tried to bring diversification into the trust, both geographically and across asset class. So the trust invests in the loans of consumer platforms, consumer originators, consumer loans, small ticket SME, small balance SME, trade finance where it can, and that's not always been easy to find in reasonable scale, and increasingly secured lending. So we do quite a lot of lending secured against prime property.
Right.
And then geographically, we found working within Commonwealth countries or English-speaking countries where we understood the law, like the US, which is obviously not Commonwealth, but it is a standard of law that we understand. Australia, New Zealand, the UK. We haven't really done much in mainland Europe, partly I think because regulation hasn't fully got there across Europe. Many platforms operating as pseudo banks or under maybe inappropriate banking licenses, still flourishing, but we haven't really found anything that works. And also there tends to be a lower interest rate culture certainly in Central Europe. So turning that sometimes into a return for UK shareholders isn't always the easiest.
Right.
So we try to be international and bring that diversification. And sometimes that's not always been to the benefit of whilst the diversification maybe, we've had challenges with that internationalisation. We spoke quite a lot last year about the challenges during Brexit,
right,
during Donald Trump winning the election, seeing US interest rates rise, seeing currency move very sharply. Mm-hmm. All of those, in one way or another, degraded returns. So whilst internationalisation and diversification, are good things, I believe,
right,
they don't come for free, and
right.
and we've experienced, some pain for that.
Right, I know. Well, particularly the British pound got hammered right after Brexit, and that must have done some bad things for you.
It did, and we've hedged the pound. We wanted to expose the shareholders just to the performance of the loans, not to the volatility of currencies.
Right.
But even the hedge costs you. You need to hold cash to deliver cash potentially to the hedge, whoever's managing your hedge. On the few days immediately after Brexit, we had to provide a lot of cash to our counterparty. Didn't lose any money per se, but you're sitting on idle cash. It's not in loans, it's in the bank.
Yep.
And we wrote about this back at the time, but it was well over 10% of the fund, the circa 15% of the fund held in cash that's not earning you interest, mm-hmm, while you protect your shareholders against. So in some ways, I look back and think one did an okay job of protecting investors, but it certainly didn't help your performance sitting with 15% of your investors' capital in cash.
Right.
And that's one of the challenges of an international business.
Yeah. So I want to go back to talking about the P2P piece here, because obviously when Lender began, Lender was focused on peer-to-peer lending, and we've evolved as the industry has evolved, and now that it looks very, very different now than it did 4.5 years ago. Mm. So how is that? Just take us through the evolution of your fund, and I know now that you work with obviously companies that are not anything to do with P2P, but are direct lending platforms of somewhat. So just tell us about that evolution.
Yeah, I think the evolution of those initial peer-to-peer platforms was a gateway, the initial gateway, or sometimes I used to say when I met investors, it was almost the first ticket to the party that invited a different form of capital to be able to fund lending. Up until that point, at least in my experience, banks and a small number of financial institutions had been the lenders, mm-hmm, to consumers, SMEs, trade finance and property. The peer-to-peer model broke that for the first time. It allowed non-banks to genuinely access the market using, obviously, low-cost distribution methodologies like online aggregators and mail. So, I think whilst the model has evolved hugely and not everyone is peer-to-peer anymore, many of the originators we work with today are not a peer or effectively retail peers. That initial model gave the, if you like, I think lit the blue torch paper for different forms of capital to access the market. And you're right, Peter. When I look back, how many of the platforms we work with today would you class as pure peer-to-peer? How many of them have 20,000 retail customers on one side and 20,000 on the other? Not many, is the honest answer.
Close to zero.
Yeah, close to zero. They've evolved, and the platforms themselves have brought in institutional capital. I remember doing meetings when someone said to me in the very first round of capital raising, when we raised the first £200 million, saying we're going to work with peer-to-peer platforms. And one very sharp investor said, well, except you're going to break the name because it's about to become peer-to-fund, isn't it, or P2B. And that's absolutely correct. As institutions have come into platforms like Lending Club and Zopa, who work with institutions, it's slightly changed the people's perception. And now we see platforms come to us, or let's just call them originators, who actually just work with one or two institutions on one side and a conduit to lenders on the other, maybe through a very small number of channels, specialist channels. And actually that works perfectly well. In many cases it can work better. One of the great challenges, I think, with pure peer-to-peer is that the price of the loan, if you're not careful, can be driven by the crowd rather than the volume of the crowd, rather than necessarily the risk price.
Right, we've seen that. So.
We've seen that, and it's hard to, it's hard to work with every platform and get exactly the right. It depends on the motivation of the platform. So we've had to try and be careful of who one works with and how you structure who you work with.
Right, and just want to touch on leverage, because you've mentioned it a few times. How much leverage are you actually using today, and how has that changed?
So I don't think leverage is necessarily it's not a sort of means to an end, or it's not necessarily a goal for anyone. We at P2PGI we chose to try and focus on what we thought were the lower risk parts of peer-to-peer originations. We had probably, because we were facing institutions, we had less of an appetite for the higher volatility areas of lending, where maybe gross lending is at high interest rates and losses are at higher numbers. The net could still have been good, but we just felt that as a first vehicle to be offered to institutions, we felt institutions would look for a lower risk opportunity rather than. So that's how we set ourselves up. We also saw that some attractive originations from some of the platforms wouldn't necessarily meet our shareholders' return target standalone. Didn't make them bad that they couldn't do that. And if I give a very real example, the fund tries to return 6 to 8 to shareholders. There could be extremely attractive risk-adjusted loans, we believed, at 5.5. Doesn't mean you shouldn't buy them though, or perhaps you could go and work with a bank and get leverage against that loan and bring that loan into the portfolio with a modicum of leverage. So the trust is, I think, relative to a bank that might be 20, 30, 40 times levered, the trust has a cap at 1.5 times leverage.
Okay.
And today is around half that levered. But could it be unlevered completely? I think it totally depends on the availability of attractive, risk-adjusted loans. I think we found around the right level of leverage, and now the key though is to try and drive down the cost of that leverage rather than necessarily worry about how much you have. If you can drive down the cost, you arguably need less of it to achieve the same return. And one of the frustrations maybe of the last 4 years has been the cost of leverage, borrowing money from financial institutions or indeed the bond market or securitization market. Hasn't always been a smooth path. It's been quite costly to be the pioneer.
Right.
The very first time you do a leverage facility with a new bank, he wants a fee.
Right.
He wants an arrangement fee. He wants a non-utilisation fee. He's not necessarily seen this before. So being first out the traps isn't always best. And I think probably the goal for the business over the next few years is to clearly improve returns. One of the levers we have to pull on that is driving down the cost of borrowing. And I believe we're making great progress on that, but it's not always the smoothest.
Right,
path.
Right, I'm sure. So I want to talk a little bit about, I know you've met with dozens and dozens of platforms over the years. Can you tell us a little bit about sort of the due diligence process that you do when you're approaching a new platform, and then how do you kind of make the decision to bring them on to your platform?
Sure. So, I mean, you're right. I've probably met, well, like you, Peter. Probably, I don't know how many I've met. I'm going to guess. It's something like 300-400 probably.
Oh, wow. That's a lot.
But I've been fortunate enough to go to Australia and meet platforms there, and San Francisco to your event, and meet hundreds of platforms who've come to your events. And only this week in Europe. I don't know how many platforms you had there. It must have been, can't have been far off, sort of 100 or something. But there were lots of interesting parties. So, and I think, firstly, we do seek, I mentioned earlier, we do seek a sort of, if you like, a quality of provenance. We want to see people with grey hair in businesses, if we can, who've remember a tough cycle, who've had a tough time, who start with credit and not losing money as their first thought, rather than the first thing they say to you is how massive they're going to be. That might scare you a little bit more. So we're less interested in their scale and their equity value, and we're far more interested in the quality of loans they can produce for us and that ethos. And I think that's where a conversation stops. We obviously want to be diversified. There's not much point in having 7 US consumer platforms to work with. I think if you can work with the 2 or 3 best, then we can bring in diversification. And our due diligence process is typically 6 to 9 months it's taken us to bring platforms on. I think one of the things that's changed in those early days, the IT, we built the IT to connect to Zopa, to RateSetter, to Funding Circle. We built it, and it was a real challenge. I mean, no one had done it before, to connect out to these platforms with an API to select loans or select grades or whatever it was we were doing. We saw real value in that tech at the beginning. Part of the DD was that tech. It's become far more ubiquitous today, and there's much less value to add in that area. So the due diligence today is very much, around the loan process, the mental, if you like, sort of attitude of the platform towards sort of protecting the investor, rather than necessarily just growing. We've also, over the years, matured in terms of putting in skin in the game aspects of that. And I think one of the most recurring messages from skeptical investors is their concern about the skin in the game, the different motivations of an investor like P2PGI versus a platform. How do you solve that equation? And I think we've worked really hard to bring in elements to our contractual relationships that provide skin in the game, try and create an alignment between the platform and us. A good example of that is where we lend secured lending against some of the real estate. The platforms we've had quite a strong hand in helping to build have a first loss element in them. So the platform wears an element of first loss on the loan. I think that really focuses the mind of the platform, because he doesn't want to lose money.
Right.
And that's something that's evolved that wasn't necessarily in place in 2012-13.
Okay, so I want to get to the performance of your fund. Obviously, this is a publicly traded vehicle. Anyone can go and look in and see your performance over the last 3.5 years or whatever. So talk us through a little bit about how, the challenges that you've seen, and now obviously it's trading at a
discount,
fairly deep discount. So just tell us a little bit about that.
Sure. So the fund has had this return target set in 2013 of 6 to 8% to its shareholders. And at that time, I think 6 to 8% was looked at an attractive level of return for something that possibly to some investors certainly looked like a new asset class, and but maybe an asset class that not everyone was entirely sure about. In the 40 months, I think it's now 41 months actually since we've been listed, so a shade over 3 years, the fund has produced a NAV return of 17.5%-ish, around 17%. So not quite a 6% yield. If you spread that over, it's a little less. It's sort of 5.7, 5.8. That is definitely disappointing to me. I'd much rather have clearly have produced 7, 8% during that time. And in the first year and a half, performance was stronger than it has been in the last sort of 12, 14 months. It's all too easy for, I think, a fund manager to make excuses, so you absolutely shouldn't. I mentioned some of the external factors earlier that gave us a challenge last year, and some of them is, you have to stand up. We don't get everything right. I think we were at times overly exposed to US consumer. It grew very quickly, US consumer. I think Lending Club did a very good job, but at times possibly the portfolio became overexposed to that. We're now going through a rebalancing, and I'm pleased to say I'm very confident about the rebalancing and the effectively reshaping of that portfolio to be able to produce those returns. I'm more excited today than I have been about the external environment, because we have far more choice today than arguably we had in 2012-13. And I think the ability to redirect the portfolio is a good. It's worth saying it's a little bit of a super tanker in that a typical loan that we hold may have a 3-year life at origination, 18 months weighted average duration. It does mean that it takes time to adjust the portfolio, and at any one time 3 or 4% of the fund might be amortizing in a month, but it's not 20% of the fund amortizing in a month.
Right.
So it can take a bit of time, and that can be a bit frustrating to adjust. And it's certainly, I think, been some areas where maybe our exposure to certain asset classes through currency or through leverage hasn't necessarily worked perfectly. I think I look now at what we're doing, and I'm quite excited about about the future.
Right. So, and just on that, I mean, I feel like, I've written about this extensively. I share my own returns publicly, and some of the weaknesses in US consumer, particularly in that latter half of 2015, early part of 2016. I imagine you held a lot of those same loans that I did, or similar type loans. Is that how much was that a drag on your returns?
To be honest, I think when people talk about performance of loans, they obviously focus on the delinquency, the net return they received on the loans. That's all that really counts. But as I say, I think we also, in addition to some variance in performance, and I think bearing in mind that P2PGI has had a focus on the prime end of the curve, typically on ABC grades, shall we call them. Some of the challenges you're talking about occurred outside that area. They were, I think, some of the platforms had weaker performance, maybe in the more the mid prime.
Yeah.
We're not exposed to that, so I can't really point to that. And I think one of the things I'm sort of proud of is that we stuck to our guns and tried to stay prime and avoided a lot of those challenges you're talking about.
Right.
That said, we still had our own other challenges through currency, through Brexit, through possibly the expense of being a pioneer in leverage, the cost of being the first guy to borrow money in scale from JP Morgan or Deutsche Bank or whoever it be. There were other elements to fund performance. As you know, to date we've not had a down month. So some of those loan performances, when you look at them, whilst I think most platforms have had a cohort or two they're not proud of, that to date we haven't had that money losing sort of a moment. And the other thing I think it's worth saying, and I said this the other day at your panel, Peter, at Lendit, is we launched with a target of 6 to 8% in 2014, actually, when we raised the capital. Huge amount has happened since then. The world's understanding of yield has shifted immeasurably. What the coupon that you can achieve today from liquid credit assets is a fraction of what it was in 2013-14. The bond market and other liquid fixed income markets have adjusted their expectation of what coupon they should expect for given risk from lending downwards. Mm-hmm. The equity market has not. I'm not saying that's wrong or right, because their equity, the equity market seeks to, investors who invest in our fund also invest in Vodafone or in British Airways or in Sainsbury's or Scottish and Southern, and that's their benchmark, and they want all of their stocks to perform above their benchmark. Of course they do. So we just have to. I think one of the challenges of working with a listed vehicle where your investor's benchmark is not necessarily the same as the assets inside the fund, is one of the challenges. But nor do I want to introduce, unnecessary risk to sort of bolster performance. I don't think that would be a good idea either. I personally think this trust can achieve that 6 to 8 without doing that, but probably taking some of the learnings of the last few years and applying some of them. I think we have quite a lot of learnings to regurgitate back into our processes. Right.
Well, we're almost out of time, but I want to cover the recent changes that you've had. I think it was just last month that you completed your merger with Holland Street. Can you tell us about that process?
Sure. I think Marshall Wace was an amazing partner for the original concept. When I first met Marshall Wace in 2013. Both parties were enormously excited about the ability to work with them. Incredible fund manager, enormously successful in equities, and the idea of being incubated by them and being able to draw on their skill set, experiences, and most importantly, probably their infrastructure. You remember at the beginning, this was a very IT intensive business, but not just infrastructure, but legal and compliance and and all the skilled people in the building. It was great. I think as time goes on, I think they're a very, very big, very successful equities manager, and I think as we evolved, I think both they recognised that and we recognised that maybe in a more mature phase that we might benefit from being part of a dedicated fixed income group. Marsh Royce isn't that. It's an incredibly successful equities business. Pollen Street is a very successful PE and lending business, not a dissimilar size to Eaglewood either. So the synergy of size, the synergy of merging with someone who does a similar thing to you, who has skilled people who do exactly in some areas what you do. Synergies in areas like servicing and loan origination and understanding. And so I think all parties recognise there would be that would be a synergy that would also resonate well with our shareholders. Mm-hmm. And I think the shareholders increasingly wanted the manager to be able to have a broader river to fish in, mm-hmm. but with the appropriate skill set as well. It's all well and good saying I've got a broader river, but do you have the skills to do that? And I think with the merger with Pollen Street, we're not only broadening the river, but also broadening the skill set and giving the shareholders of P2PGI a broader skilled management team.
Right. Okay. So last question. I know you can't make any forward-looking statements, so...
No, I can't.
So I just want, let's talk in just general terms. General terms about like the future of your fund and the industry. Where do you see this all going over the next 3 to 5 years?
Yeah, I mean that's a great question. I think we're seeing really exciting growth. Consumer lending on peer-to-peer platforms was almost the pioneer. Mm-hmm. Lending Club Zopa was the pioneer. Zopa, followed by RateSetter Lending Club, etc. But the asset classes are evolving now, and we're seeing many, many different types of loans be made available to non-bank funders in different structures, not just listed funds, but also in private funds, closed-ended private funds, in some cases open-ended, which I'm less keen on, and asset classes like leasing or like property lending or mezz property lending, so really, really sort of products that you naturally associate with a bank are now opening themselves up to competition and other types of funding. So I think we're at the point where you'll see a growth in specialist funds. P2PGI was a generalist fund. It was offering investors access to the whole gambit of disintermediated small ticket loans. Back then, some of the individual asset classes were just not big enough to support a standalone fund, but today they are. It's perfectly possible we may see US SME funds or US or European trade finance funds because those asset classes are growing. So I think the investor's going to see a wider choice. Mm-hmm. I really do think the concept of lending not through a bank, it's been around for hundreds of years, frankly. It's just, I just think in the last few years technology has widened its availability. So I think fund managers like Pollen Street have a great opportunity to deliver products to investors that give them an alternative to investing in the traditional banking methodology.
Okay, well, we'll have to leave it there. I really appreciate you coming on the show today, Simon.
Thank you very much, Peter. Nice to see you.
Okay, see ya. I wanted to go back to a point that Simon made a little earlier there, and that is this whole idea of pure peer-to-peer lending platforms and the fact that they don't really exist today at scale, with the possible exception of RateSetter in the UK. We live in a world where the large amounts of money are much cheaper for these platforms to raise. If you're a small number of large investors, it's just a more efficient way to run a platform. Now, I wish that wasn't the case in some ways, because I feel like, I started off in this industry as an individual investor, and when I started, there was only individual investors, and that's one of the things that really attracted me to the asset class. But the reality is, particularly in the United States, we live in a regulatory regime that makes it very difficult. There's only, beyond Lending Club and Prosper, there's a small number of platforms that make their investments available to non-accredited investors. That is a shame, but that's just the reality of the world we live in. I would like to see more vehicles, like Simon's fund in the United States, publicly traded funds where individual investors can get access to a diverse investment of across many platforms, which they're able to do with P2PGI. But we're suffering from the regulatory regime in the US that makes those sort of offerings difficult to achieve in the United States. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lend It USA 2018, the world's leading event in financial services innovation. It's happening April 9th through 11th, 2018 at Moscone West in San Francisco. It's going to be the largest ever fintech event held in the Bay Area with over 5,000 attendees expected. We'll be covering online lending, blockchain, digital banking, and much more. You can find out more by going to lendit.com/USA.